Now, once again, Raymond Arroyo.
Welcome back to The World Over Live. One challenge we all face: where should I invest my money? Is it too early? Is it too late? Should I start saving for retirement? Should I pull it all out? How does one navigate the current financial markets? My first guest will tackle all of this and more. He's a portfolio manager and founder of Schwartz Investment Counsel and the Ave Maria Mutual Funds. Would you welcome George Schwartz back to the program? George, thanks for being here.
Great to be with you.
And you braved the snow, made it, and you're going to try to escape the blizzard.
Tomorrow morning.
Okay, fingers crossed. I want to start with the volatility of this marketplace. We've seen the stock market crater. It's bounced back a little bit in recent days. They say January sets the course for the year. What might this year look like, George, given your history with the market?
Well, January does sometimes set the path for the year, the course for the year. They often say the first 5 days of the year sets the course for January, and then the whole month of January sets the course for the whole year. And so far it's been down, 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 down. And we are, in my view, halfway through a bear market.
Halfway through. When did it start?
Well, the market peaked out in the middle of last year. And historically, bear markets last about 10 months on average if there's no recession. And we don't think there's going to be a recession connected with this bear market. If there is a recession, and we are going into one now, which I don't think is the case, but if we are, the bear markets have historically lasted 20 months.
Oh, boy.
But if we're halfway through a bear market, there'll be great opportunities during the first part of this year, the first few months of this year, in my view.
Okay, so now this is the time to scoop up stocks, you're saying. This is bargain basement time. Grab them now.
Yes.
Okay, we're going to talk a little bit. Oil has been a big part of driving the world markets down. 75% drop. I mean, it's been incredible watching this.
Yep.
And it has plunged so many of these other countries into recession. Brazil, Russia. What impact will this have? Africa. What impact does this have on the United States investor and on our own economy here and in Europe?
Well, it's a negative for the oil companies and the oil suppliers. There's no question about that. It's a positive for consumers. You and I are enjoying much lower prices at the pump for
It's like a
gasoline.
tax cut, really.
It is like a tax cut. But China has been the big swing factor in, after many years of rapid growth in China in their manufacturing economy and the growth of their infrastructure, they were sucking up a lot of commodities, including oil. And
they're all cratering. All these commodities. Why?
Well, China hit a wall. They overbuilt, they got too much capacity, they borrowed a lot of money to do all this infrastructure expansion, and they couldn't go on forever doing that. Their debt is 250% of their GDP, gross domestic product, which is huge. And their combination of communism and capitalism is really unwinding now. And there's not the demand for those commodities. And in the case of oil, which you brought up, the supply is increased dramatically because of the fracking, the hydraulic fracking that's going on in the U.S., which is a marvelous invention and has made the U.S. the largest producer of hydrocarbons today, oil and gas, which is great for our country and great for our possibly our independence from the Middle East cartel.
You mentioned China and their economy slowing down. We also have the problem of the manipulation of the currency in China. How do you deal with that? And as an investor, are you invested in China at all?
No, not at all.
Not at all?
No.
Why not?
You can't believe the numbers that are coming out of China. They're all controlled by the government. They don't have accounting firms like ours that certify the accuracy of the financial statements on their companies.
So there's no way for you to accurately diagnose where these companies are or their projected growth.
Right, and the quality of their management and the integrity of their managements are very much in question. And they're mostly controlled by the Chinese government, the communist government.
A lot of our audience, and I've been reading emails all afternoon about this, they're asking, what should we do? Should I go to stocks? Should I go to bonds? Should I go to cash? What should I do, George Schwartz?
Well, in the long run, the way you make money in the stock market is buying stocks. The way you make money in investing is to buy stocks. Stocks of high-quality companies, ones that are paying good dividends, and companies that increase their dividends every year. In our Ave Maria Rising Dividend Fund is the classic approach to investing, in my view.
And how do you structure that? How do you survive the volatility of this market? We've had a couple of lousy years here, George.
Yeah.
And I mean, I'm thinking back to 2008, which I'd rather not think about. But this feels like 2008 again.
It could be, but the 2008 was instigated or started by the financial collapse. That's not likely to happen again. The overextension of the banks and the mortgage companies and the
In the United States.
in the U.S., right, and Freddie and Fannie, which played an integral part in Fannie Mae, Freddie Mac, played an integral part in the overexpansion of the housing sector and the housing bubble. That all fell apart. That's not going to happen again, at least not in that same way. So.
So how do you, as a fund manager, hedge against the volatility and the cratering of even things that were the foundations of your portfolio, commodities, basic steel and oil and cotton? How do you get around this?
We don't really hedge against the volatility. The volatility is your friend, really. It provides an opportunity to buy low if you buy the right companies, the right stocks and bonds, actually. We have a bond fund as well. But the trick is to buy high-quality companies, well-managed companies, and hopefully they're operating in a morally responsible way, which is our whole theme of investing.
Tell me, for people watching, they're looking at this, they're about to retire or they're in the middle of retirement, they've got their money tied up in a fund, or their 401c3 is tied up tied to a fund or a particular family of stocks. What would you recommend they do at this moment?
Well, if they have an adequate amount of stocks in good companies or good funds, they don't have to do anything. If they want to invest in a morally responsible way, which we advocate, like our Ave Maria mutual funds, they could switch some of their money into our funds.
And you have a committee of people, everybody from Michael Novak to Phyllis Schlafly to others, who, what do? They evaluate certain stocks and the moral implications?
No, they set the standards for what we should not invest in.
I see.
They tell us not to invest, we as portfolio managers, to not invest our shareholders' money in companies that support abortion, embryonic stem cell research, Planned Parenthood, or pornography. So we screen out those companies. It screens out about 150 companies out of the Russell 3000. So about 5% of the largest companies in the U.S. are screened out, and we can invest in the other 2,850.
So if people want to invest morally, they can go to a fund like the Ave Maria Fund, right. Or you could go to an index fund. People tell me, go to one of these index funds. Now, these aren't managed. Tell people the difference between a managed fund and an index fund, which is sort of, to my mind, it's like, going to Vegas and just throwing it all on the table and letting it ride.
Well, the actively managed funds like ours are run by professional portfolio managers and have a staff of analysts and so forth that pick stocks or bonds for that fund.
And sell them actively and buy them actively.
Yeah, not like day trading, but sell them from time to time when they get overpriced or when the company doesn't perform properly. But a passive fund or an index fund is a fund that buys stocks that represent the S&P 500, for instance. There'll be 500 stocks in the portfolio or a close facsimile, and they just hold that portfolio. And so there's nothing wrong with that. Index investing has gotten very popular, and it's okay. It's not morally screened like ours.
Right.
But if that's what someone wants, there's nothing wrong with index funds.
What about gold? We keep hearing William Devane and others. At this point, I'm about to go and say, I'm Raymond Arroyo. I've got gold in my closet. Is gold a decent hedge for this volatility?
Gold is not an investment, and I have said for many, many years people should have a small amount of gold in their portfolio as an insurance policy.
Gold stock, not coins.
Coins, stocks, it doesn't matter. And it's not an investment. I own gold personally, and I hope it goes down. I hope it continues to go down.
Why?
Because it's an insurance policy. I buy insurance on my house, but I don't hope my house burns down. Right?
I hope not.
I have gold.
Depends on your house, George.
Yeah. I have gold, and other people should have gold in case the whole financial system falls apart and capitalism ceases to exist. Gold might go to, $5,000 an ounce or $100,000 an ounce. There's no way of knowing. But the point is that gives you a hedge or something tangible that will appreciate, because gold is a store of value and is it's an insurance policy, though. But don't consider it an investment, and don't buy it hoping it goes up.
A lot of people are selling off like mad. They're seeing this volatility. They also see my retirement is just around the corner. I can't risk this. You would advise them to do what? Particularly if they don't have, hundreds of thousands of dollars hanging around.
Well, there's nothing wrong with cash or money market funds. They don't produce any income. The good news is they don't go down in price either. And for a short period of time, or if someone wants to strictly preserve principal and are willing to run the risk that inflation comes back and they won't be able to keep up with inflation with a money market account, that's what they can do.
That's it. But you're getting such a tiny percentage on the money market. You're getting what? Point nothing. Yeah. I mean, that's basically what you're up to.
It's a parking lot.
Point nothing.
For active investors or for long-term investors, a money market fund is a parking lot. Put your money there pending a more permanent investment.
And the Federal Reserve is threatening to raise rates. You think that'll happen given the volatility of this and fragility of the market right now and the economy?
It's unlikely that they're going to stick to raising the Fed funds rate a quarter of a point per quarter for the rest of the year. That's what they had implicated that they might do. And my guess is they may raise it once or twice more during the year. But essentially, the extremely low interest rates continue to be highly stimulative.
Is there any correlation, just before I let you go, and we only have seconds, between a newly elected president and the markets? Do they respond? Do we see a trend line in history? Someone was telling me something about this the other day.
I think it will this time. If we get a pro-life, pro-growth president, it's going to have to be a Republican, of course, I think the markets could do extremely well.
Okay. George Schwartz, thanks as always for being here.
Raymond, my pleasure.
Fascinating. I bet we'll be in touch with you more often, given what we're watching in the market. Thank you, George. If you're interested in finding out more about George Schwartz and morally responsible investing, visit AveMariaFunds.com.